All right. Well, welcome everybody. Good evening to all of you, and welcome to our new tax law workshop. First thing that I want to say, as you all know, we are not tax advisors. We are financial advisors. Marcus Rather and Emmett Corboy with Cetera Investors. We have, a bit of a few different, things that we're going to get into here tonight. As Marcus mentioned, this is going to be one of our longer sessions for those of you who have kind of tuned in to a few different ones that we've done throughout this year. We thank you for, continuing to tune in. Typically, we try to keep those to about 30 minutes or so. Tonight, it's probably going to go a little bit closer to about an hour or so. So, if you can stick around for the whole thing, you won't be disappointed. We've got a lot of information in here. But if you need to hop off, I absolutely understand that as well. First thing that we want to get into, just kind of in terms of our goals for tonight. Marcus, do you have the material to pull up there?
Let's see what we can see.
All right, so go to the workshop goal. There we go. So we're going to highlight 4 different keys that exist within the tax law now. And part of this is going to kind of harken back to 2017 when the tax law changed. And, you might be thinking as we go through this, well, why are we going to go back to, comparing things to 2017 or, even how it was before that? Well, keep in mind that some of those changes that came about in the 2017 Tax Cuts and Jobs Act are set to actually expire in 2025. So within these 4 keys that we're going to go through, you will see not just, how things are today, but what could possibly be coming back, within the next few years with the sunsetting of some of those provisions as well. And throughout the evening, we'll kind of highlight, some different points of questions to ask yourself. I will also give a little disclaimer throughout the evening. If you hear me clearing my throat, coughing, sneezing, anything along those lines, I am battling some type of cough, cold right now, as I think a lot of us out there are. So the key thing, like I said, we are not tax advisors. The context of what we discuss today is really, should be, looked at and viewed within the context of your overall financial plan. And as you think about different tax strategies and that sort of thing, we as your financial advisors love to, look at that with you and alongside your tax professional as well. And we can kind of coordinate, a strategy, together for you on everything. So again, with this quote unquote new tax act from, what changed in 2017, a lot of us are probably familiar with, how this is at this point in time, but some things to kind of always consider is how do these tax laws affect me, right? And how can I position myself to benefit even more, and are there any changes that maybe I need to make, whether it's now or in the future, to make sure that, from a overall, standpoint of what's being paid out to Uncle Sam, that, you're not overpaying, but, keeping things positioned properly, for everything. A little bit of just, again, kind of a review of the, new tax rules. The reform in 2017 was the most far-reaching reform since 1986, which again is why even here in 2022, it's important to kind of review this because, it impacts each and every person. Most people kind of comparing back to that, prior time saw some sort of net positive in their bottom line or, paid less in taxes. But, revisions continue, right? And that's why, here we are, discussing what has been revised and giving you the up-to-date numbers based on where we're at right here now today in 2022. This is also timely given that, we're coming up on year end. And I think a lot of times we get questions as financial advisors in January, February, March, all the way up till April 15th with the tax filing deadline on, well, what do I need to do, for my taxes, right? At that point, it's kind of a little bit too late, right? You can't do anything, you can't do much after January 1st to impact your prior year's taxes, right? So we have some time now between now and December 31st where potentially there may be some things for you personally to consider or look at and some changes or maybe gifts to make that can impact your tax situation when you go to file by April 15th of next year. As I mentioned, one of the big things is that a lot of these individual changes that came about will expire in 2025. And, from just a, political standpoint, this wasn't something that had bipartisan support. And this is something that really was kind of fought over in Congress and, between parties. So as we sit here today, just after the 2022 midterm elections, got a different, president in office from a different party. Who knows what's going to happen, in 2025 or after the 2024 presidential election, with this particular, tax law as well. Is that going to be something that, gets, renewed and things are pushed back, or is it something that, tries to be eliminated? So the four keys that we are going to review, first is that a lot of the deductions, so the first one applies a lot to just your personal returns with deductions that may have been eliminated that you may need to look at. Key number two, we're going to look at the locality in which you live and how much of a difference that can make. Three, we're going to look at that within the family context of things, looking at more of children, schooling, marriage, estate planning, retirement, and how all of this kind of ties together from that perspective. And then key number four, we will address businesses and small business owners and how these rules impact them as well. So without further ado, I'll pass it to Marcus to handle key number one.
And please take a water break because we have a lot of
information. Oh, absolutely.
We have a lot of information to go through this evening. So you're going to see Emmett and I flipping pages because there's just so many details, so many notes to disclose here. And I really appreciate Emmett going through the context of why we're covering this topic today. Because major bullet point, if anything, I think we had an over-under on a few different words or key favorite phrases you may hear from us this evening. One is that we're not tax advisors. So I think we're at number 2 for that. So if you want to keep track and have fun, we might have a raffle prize to whoever guesses the correct answer. But we have over under on, we're not tax advisors. How many times you should connect with your appropriate accountant and professional. But we also want to just give you the right context to prepare for the tax season that's going to be right around the corner entering into the new year. So key number one, tax deductions you counted on in the past may have been eliminated or changed. Again, this isn't something that's new as of this year. This is really a major overhaul that came into play following the Tax Cuts and Jobs Act in 2017. So there's 7 items that you should know about the new deduction rules and tax rates. And a lot of the context, again, is coming from 2017, but we do have new numbers, right? So a lot of the numbers that when you filed for 2020-21 this year, some of those numbers are going to be different when you go to file next year for this tax year 2022. So the first thing is that your tax rate has dropped by 2 to 4%. So for the tax brackets that we had, the top tax bracket was lowered from 39.6% to 37%. So across the board, every tax filer should have seen some type of adjustment in their tax rate by percentage. The estimated average savings, as you can see, was about $1,600, which means higher income earners will see more of a reduction than lower earners. But there should have been some extra money that you've seen in your paycheck following this law being passed. Now, again, we're 4 years into this law being passed. So a lot of the immediate effects following the law you may, already have been accustomed to. But what we want you to be familiar with are the tax brackets for 2022. So as an example of that change, you can see in 2017, the tax brackets were 10, 15, 25, 28, 33, 35, and then the top bracket being 39.6. But with the passage of the law, that's reduced the tax brackets to now 10, 12%, 22, 24, 32, 35, and 37. Now, again, 2017, 2022, this is not a brand new concept, but what is different is the dollar amount that fits within that bracket compared from last year to this year. So just to throw out some numbers out there, not that you need to perfectly know them or memorize them, but to provide some detail to the difference. In 2021, if you were filing single, where you see that 12% tax bracket, I'm gonna try to annotate something, use a tool that my good friend Emmett showed me how to do. This 12% bracket here, the top bracket, the top dollar value for that was $9,950 back in 2021. As you can see for 2022, anything past 10,000 will enter you into the 12% bracket. For single filers, the amount for 22 is 40,525. 22% was 86,375. I don't want to go through the whole list, but as you can hear that the dollar values have changed from 2000 and 2021 to where they are today. So there has been some dollar value increase of where that tax bracket falls. And if you're someone that's filing as a married person, married couple, the dollar values are different as well. So for 2021, if you're falling within a 12% bracket, the top earnings, this number here, that 83,550, that was previously $81,050. So they have adjusted the dollar amount that falls within that bracket. But across the board, the average new tax savings should be $1,600 for the average tax filer. And we should be good to go. Maybe not. Technical difficulties, please pardon me.
You should just be able to hit clear all if that's what you're having issues with.
Yep, definitely had an issue with that. So let me see if I can get back.
Right.
So clear all, trying to get to the next slide.
Yeah, so that's, overall those brackets kind of increased by about 4 to 5%. It's when we look at inflation, it's going up a little bit, but we've heard about the rampant inflation that we've had this year as well. So,
and we're going to touch on that in another few slides as well, because that is something else that has changed with the Tax Cuts and Jobs Act. So the important thing to check is your withholding amount. With the change in the bracket or the reduction in that percentage, it did impact what amount was withheld from your paycheck if you're a W-2 earner or something to that magnitude where you're having taxes withheld. So it is important that you're checking or being sure that you're having the right amount withheld each year. And just to avoid any confusion, last year, a lot of taxpayers were upset about smaller refunds, even though less money had been withheld throughout the year. So there's more money that you experience in your paycheck that you were able to save or, use for your goals or anything along those lines. So a question to ask yourself following that change in bracket is, one, am I sure that my tax withholding is correct given the new tax bracket? And one way that you can check this is through the IRS website. It's www.irs.gov/individuals/IRS.withholding-calculator. So there is a brief resource that you can check into to analyze or identify if you're having the right amount withheld from taxes.
I feel like we need to have like a ding, 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 ding whenever those questions to ask yourself come up, because those are times definitely to take out a quick pen and pad and just write that down. And yeah, Marcus mentioned a great way that you can check that through irs.gov as well.
So number 2 of 7, if you don't already, you'll likely start taking the new standard deduction. So with the passage of the Tax Cuts and Jobs Act, what that has done is increased the standard deduction. So much so that 90% of taxpayers are expected to start taking the higher standard deduction opposed to taking the itemized deduction. So most of tax filers that you've already seen, again, passing since 2017, you may already be accustomed to taking the standard deduction. Now on the next slide, it is going to articulate the dollar amount, and I do want to provide context of what's different from 2021 leading into this year. But the key tax change that occurred here was that they did double the standard deduction, meaning it's less likely that you may itemize your expenses or take the itemized deduction on your taxes. So what did it look like in 2017 for people taking the standard deduction? If you were filing single, that amount was $6,350. In today's time, that's $12,950. For married filing jointly, thank you, Emmett, it was $12,700 to avoid any technical difficulties. Now your standard deduction is $25,900. God, man, you're a wizard with that thing, aren't you? So in 2021, what that dollar amount was for single filers, it was $12,550. So you can see there was about a $400 increase to the standard deduction for the 2022 tax year. And for married filing jointly, it's $25,100. So there was an $800 increase on the standard deduction for 2022 as well. Now, a few other bullet points not on the slide I think is important to remember. For those that are joining us that are 65 or older, or if you're blind, there's an additional $1,350 that's added to that standard deduction. So there is some blessing in getting older from a tax standpoint. But what did change with the tax law is that they did eliminate the exemption. So understand what a deduction is. A deduction is something that reduces the income before income tax is applied. So this deduction is going to reduce the total income that you show before income tax is applied. And the exemption was a dollar amount of your income that's exempt from being taxed. So that, put that in the context, people that had children, large families with many children or even dependents, with the removal of that, that may impact many large families or large households with the elimination of that exemption. But again, these laws, this part of the law is sunset in 2025. So this is something that eventually will change, whether they elect to continue or they elect to change it. It is something that was sunset in the year 2025. So just as a brief example, we have Jane and John Doe, something that's not on the slide, but it's important to understand in this example. Jane and John, they're married, they have 2 children, they have a combined salary of $71,000. And we're assuming here that they're saving 10% into an employer-sponsored plan. So that's going to go in on a pre-tax basis. So under the old law, if they took the standard deduction for a married couple, they have the exemptions and they get the child tax credit, they have a total taxable income of $35,000, which would lead to a federal tax of $2,317, as you can see on the screen. Under the new law, with the double of the standard deduction, let's say they continue to put in 10% into the 401k, well, because of the standard deduction and the elimination of the exemption, they actually show more total annual income on a tax basis. However, their tax bracket drops from 15% to 12%. And with the child tax credit that has come into play, their federal tax drops from $2,317 to now $149. So you can see how much of a savings has come in with the new tax law, but simply just reducing the tax bracket. So ding, 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 ding. How can I itemize deductions now that the personal exemption is eliminated and the standard deduction has increased? This is a question that you want to ask yourself as we prepare for the tax season next year. And just a quick housekeeping item, if you have any questions, please feel free to submit those questions to the Q&A feature of Zoom. We will be monitoring that as we go through our conversation today. So if you do have a question that you'd like for us to pause or double back, we will absolutely address that. Mind you, we are not tax advisors. Or 3 or 4, one of those, 4, 3? Okay, perfect. So key number 3, you're less likely to pay an alternative minimum tax. So just for context, the definition is here on the screen. We'll read it together. The alternative minimum tax is a separate way of calculating income taxes to ensure that taxpayers with many deductions still pay some tax. So this typically applies to people who are itemizing their expenses or itemizing their deductions. If you're hit with an alternative minimum tax, you'll pay your regular tax plus the alternative minimum tax difference. So what has changed in the law is, one, the threshold that triggers an alternative minimum tax. As you can see, for single or married filing jointly, that dollar value is higher than what it was in 2017. So that in itself does change the amount of individuals or families who would trigger an alternative minimum tax. But keep in mind, the alternative minimum tax applied to those who were itemizing their deductions. And with the double of the standard deduction, and as you saw, 90% of taxpayers now are taking that standard deduction, not many families are going to be impacted or have the challenge of new or alternative minimum taxes. So those who still owe may end up owing less because of these changes, but many tax filers may indeed not have an alternative minimum tax due to the change in the tax code. So some things to keep in mind for those people who have employer stock options or incentive stock options, the sale of that or how you execute or exercise that choice, that could trigger an alternative minimum tax liability. What's suggested is that you connect with professionals like Emmett and myself or the appropriate accountant to identify strategies of how to defer or stretch out that liability just to minimize the impact that AEMT may have on the sale of that. Exercising options over a series of different tax years may help. So again, we want you to make sure that you're seeking the right and the wise counsel on how to navigate that option or that choice that you have from the stock option. So another round of things, questions to ask yourself is, will you be subject to the alternative minimum tax? And if so, how can you minimize the impact? So don't see anything in the Q&A feature just yet. So we're just going to keep on rolling because, again, we have a lot of context here. So number 4, still under key 1, but number 4 out of 7 is that you can deduct more out-of-pocket medical expenses. So this is something that has been extended into 2022. I believe from previous notes, they said this may sunset in 2020, but due to COVID and things, they have extended your ability to deduct out-of-pocket medical expenses. Now, in context, medical expenses are typically an itemized deduction. So you want to keep in mind, where standard deduction applies and what expenses count towards your itemized deduction. So the new law will affect how much of you pay out-of-pocket healthcare. Many individuals with large insurance premiums or large deductibles can take advantage. And again, we encourage you to seek tax advice. What that change was is that they deducted or they reduced the amount that you're eligible or that you can deduct for itemized expenses. So previously, it was 10% of your adjusted gross income. So expenses that exceeded 10% of your adjusted gross income, that was the amount that you could use as an itemized expense. Now they've reduced that to 7.5%. So using round numbers, if you're someone making $50,000, or let's say your adjusted gross income is $50,000, that 10% limit was $5,000. So if your medical expenses exceeded 5, that's the amount that you're adding on your itemized expenses. Now that they've reduced that to 7.5, making $50,000 as your adjusted gross income, that amount is $3,750. So the more medical expenses that you incur, that would add to your ability to take an itemized expense. So a question that you would ask yourself here are there out-of-pocket medical expenses that you can deduct that exceed 7.5% of my adjusted gross income? And one disclaimer, because I saw this in the bullet point in our notes, is that money used from a flexible spending account or a health savings account, money that's used out of those accounts for medical expenses would not apply as a deducted expense, because the money that comes out of those accounts already have a tax advantage, whether it goes in pre-tax, whether it grows tax deferred, or it comes out tax free. Because you have all the tax advantages associated with those accounts, monies used from those accounts towards medical expenses cannot be deducted for the sake of tax purposes. So you do want to keep that in mind if you're someone that has a FSA or HSA and you're using those for your medical expenses. So number 5, so speaking of itemized deductions, they actually took away a lot of those miscellaneous deductions that you were previously eligible to deduct. So things like moving expenses, home office expenses, investment fees, tax prep fees, professional dues, casualty losses, those specifically have been eliminated from the itemized deductions list. Now, there hasn't been anything that I've seen that said that also is set or can be one of those sunset provisions, meaning it could come back in 2025. There hasn't been anything that says that. So to this point, it may be something that is no longer offered at all. So just keep in mind what you're no longer eligible to itemize are these types of expenses, which are moving, home office expenses, investment fees, tax prep, professional dues, and casualty losses. So a question to ask yourself are, with those changes, right, what kind of deductions are still available to me, right? How do I obtain the best after-tax return on my investment? And should I pay retirement account investment fees of pre-tax dollars? Now, I might be premature in saying this. I know somewhere down the line, we're talking about student loan interest. Favorably, we haven't had to deal with that for the last few years with the deferral of student loan payments and interest. But keep in mind that student loan interest is not an itemized expense, it's more of an adjustment. So you still be able to adjust your income from interest paid on student loans. And because those are not a deduction, it's an adjustment. So that's one of those technicalities there. So speaking of inflation, right? Emmett mentioned inflation, and I gave you an example of how they've adjusted the brackets by dollars, how they've adjusted the standard deduction. In the new law, the way that they're tracking inflation is that they're not directly using CPI or the consumer price index. And I believe from this year, I think we're all pretty acclimated to what inflation is. So what they've done back in 2017 is that instead of using the natural consumer price index or CPI, they're using a chain consumer price index. So they're still tracking the measurement of the change in price of goods and services, but the chain price index is taking in consideration any substitutes that we may use because of the rise in the prices of goods and services. So it's not naturally looking at the change in the price, but they're factoring in if we substitute Dr. Perky for Dr. Pepper, right? Using Dollar Tree goods versus things that we could get in Food Line or something along those lines as an example. So what issue that causes is that the rate by which they increase the dollar value can create what they call tax bracket creep. I had this conversation with a client of mine earlier today where thankfully she got a pay raise, right? She had an increase in her pay, but she was concerned that with the increase in pay, that may bump her into a new bracket because the brackets did not increase by the same rate or in the same proportion that her pay increased. So as your salary rises, it's likely that you may move quickly into a higher tax bracket because of the previous lower tax rate will be pegged to a slower moving chain CPI. So you may end up paying more taxes because your tax rate won't grow at the same rate as your income. So key things to just keep in mind here, evaluate your ability to receive those deductions and credits because those breaks grow more slowly over time, right? The more money that you make, the less incentives or opportunities you may have for deductions. Pre-retirees may want to consider working less or taking an early retirement. Please keep in mind your goals and your track to retirement before simply acting on that. I know we're all ready to retire yesterday, but please look at your information and your situation before making that decision. But you absolutely want to look to plan around tax bracket creep and plan in conjunction with timing and taxation of Social Security as well. So a question to ask yourself here is, do I understand the tax bracket creep? And how do I plan for greater tax efficiency, especially as I prepare for retirement? So number 7, before I grab my favorite drink and pass it off, Number 7 is that you can deduct more of your donations to charitable organizations. So this still falls in line with some of the expenses that you're able to itemize. If you're someone that's eligible to itemize, what has changed here is previously 50% of your adjusted gross income was eligible to be deducted in terms of charitable contributions. They've increased that from 50% to 60%. So nonprofits will be seeking bigger donors who now can donate a higher percentage of their adjusted gross income to charities. If you're someone that has been impacted by this, here are a few things to keep in mind. One, you can contribute highly appreciated securities to charities. If you had appreciated stocks that you prefer to donate in lieu, you can choose to donate those as well. You can consider contributing to a donor advised fund. That's a different strategy of awarding or giving funds to a charity of your choice. If you're someone that's entering into close to R&Ds, right? As we know, the required minimum distribution age has increased or extended from age 70 and a half to 72. Well, what they did not change is your ability to take a qualified charitable distribution. So if you're someone who's 70 or 70 and a half, what you are eligible to do is make a charitable distribution from qualified or pre-tax assets. That very well may be more of a tax efficient way of making your donation that can also satisfy future required minimum distributions. At the end, you want to seek tax and legal advice on exploring such strategies. So a question to ask yourself here is, should I review my charitable giving strategy in light of my new tax rate? So we'll pause briefly just for a quick second to address any Q&A that we have in the box before we immediately dig into key number 2.
You know, one thing that I'll point out on that highly appreciated securities donation, you know, when we look at, you know, just what the market has done over the last 10 years, right? You know, think back to, you know, 2012 to the run that we had up to COVID in 2020. Obviously, we saw, you know, a big drop and then it recovered. And this year it's kind of come back down a little bit again. But if you have any, you know, securities, whether it's stocks or, you know, mutual funds or ETFs that you had invested for, say, 10, 15, 20 years, likely you have a pretty substantial gain in there. And if we just use an example of, say, $10,000, right, and say that grew to $20,000, well, if you sell that and, you know, now you know, turn that into cash, well, you have to pay taxes on a $10,000 capital gain. Whereas if you donate that, if you don't need those funds and you're able to, you know, donate that to a charity or church or whoever it may be, now you don't have to realize that gain from selling it, but also that's a $20,000 write-off now on your taxes as well. So that could be something that, you know, could come into play. Again, if you're in a fortunate enough situation to have, you know, funds like that where you can donate as well. So heading now into key number 2, and one thing I'll say, Marcus, you did an excellent job with key number 1. I want the audience to all know that is by far the longest of the 4 keys. So don't think that you got that time multiplied by 4. Key number 2 here really talks a lot about just where we're living, and we're going to talk about SALT. This isn't like the salt that's on your dinner table. This is state and local taxes. Where you live is going to make kind of a big difference on state and local taxes. I know most of our clients are here in Virginia. Virginia is not an extremely high tax state, but it's also not really a low tax state either. So it's kind of middle of the road. So we're going to go over 2 important items regarding home ownership. First being homeowners in some higher tax states are going to lose their ability to fully deduct their state and local taxes. It used to be if you paid state taxes in any amount, you were able to deduct that off of your federal income tax. That is now limited to $10,000 for all state, local, property, as well as sales taxes that anybody pays in any given year. So, yeah, here in Virginia, the typical tax rate is, 5.75%. So for somebody who just, simple math here, not bringing any property tax into the equation, if we just look at income over $200,000, well, they're getting into a situation where now that can't be deducted on their federal income tax, right? Whereas previously that was, unlimited. When we look at kind of other states, states that, accounted for over half of the value of these deductions, California, Illinois, our neighbors up north in Maryland, Massachusetts, New Jersey, New York, Connecticut. I know some of you have kind of lived in some of these other states as well, and especially some of the property taxes, in places like New Jersey were kind of, and still are, off the charts in my opinion, right? But, these high tax states, failed to, find any way around this or devise any creative solutions that could help their residents ease that pain. So, one thing that, one could do is consider bunching deductions, meaning, if you, have, deductions that can be spread over 2 tax years or consolidated into one, it could be a good idea to kind of consolidate those potentially into one tax year to, maximize the efficiency of those deductions as well. So some tax insight here. If you happen to live in one of those higher tax states, within the context of your overall financial plan and your cash flow is probably going to be negatively impacted, right? So maybe you want to consider relocating to a little bit more tax-friendly state or downsizing. And it could, potentially make sense to pay off your mortgage, right? If your cash flow is impacted that much and you have the assets to pay off your mortgage, it could be a time to do that. Especially considering if you're taking the standard deduction, which Mark has covered, you're likely not deducting that mortgage interest anymore, where, previously, it was a lot more common to be able to deduct the mortgage interest as well. So ding, 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 ding. Can I still deduct my full state and local taxes, right? So think about that. When you total up your state income tax, your personal property tax, if that gets over $10,000, there's some, some money there that you're paying and not able to deduct. Should I consider relocating to another state? If you're not in Virginia, you probably should, because Virginia is the best of the 50 states, just throwing that out there. All right, the second thing, as I kind of mentioned, a lot of us, aren't deducting our mortgage interest anymore, but for those who, have more of a jumbo mortgage, they may not be able to deduct their interest one way or another, right? So you're able to deduct interest on mortgage debt up to a limit of $750,000. It used to be that limit was $1 million, and those who had that original amount, or those who had existing loans, are grandfathered in and still able to deduct that. But for any new folks taking out new mortgages, might not be able to deduct that interest. Another thing to consider is that home equity loan interest is no longer deductible unless it's used in connection with buying a home or home improvement, right? And that home improvement, I believe, has to be attached to the property that that the loan is attached to. So, if I, just use myself as an example, if I, own a home, has equity in the home, and say I wanted to, put on a new roof, for instance, right? I can borrow on my home equity loan, pay interest back on that home equity loan, and because that roof is going on the house that I live in, that interest could potentially be tax deductible. Right. So think about situations like that. And again, consult your tax advisor for specifics there. All right. So, some tax, insight on this, the con, you're not able to deduct, that new mortgage over $750,000. And with the SALT limits, your property tax deduction is limited as well. But the pro, building wealth through home ownership, that's proven to be, one of the, top ways of building wealth. And we've seen, property values, home values really, really increase over these last few years as well. So don't keep yourself from, investing in a home or buying a home just because of these tax laws, right? It all should be used within, again, the context of your, overall plan. But, something to consider, should I, speed up my, mortgage payments? Or, again, should I consider moving to a lower tax state? One question or one thought on speeding up your mortgage payments as well is if your mortgage was taken out, say, in 2020 or 2021, maybe you refinanced during that time, you may have an interest rate of 2.5% to 3.5%. Right now, the way the interest rates are, you can't, find anything less than, 6%. In fact, most 30-year fixed rates now are 7% or higher. So having that, 2.5%, 3.5% mortgage, while you might not be able to deduct it, right? It's still, a very effective vehicle that can give you leverage to, use your assets in other ways as well. So, keep that in mind before just going to, pay off an entire mortgage as well.
So as we move into key number 3, I do just want to pause and just, again, check the Q&A feature. If anyone has any questions about key number 2, please feel free to submit those questions. Definitely appreciate the particular or just reiterate some of the particular details about that. There are parameters to new mortgages, not existing mortgages prior to 2017. And that home equity loan aspect, the loan has to be used for home improvement to the existing home to where the mortgage is. So I'm just going to pause for a quick moment, check the Q&A before we proceed through key number 3. All right, so nothing yet. Must be doing a good job. Pretty clear, pretty straightforward. Love it. So key number 3, family-related tax rule changes regarding children, education, high-earning couples, divorce, retirement, and estate planning may need your attention. So again, we're talking about some of the tax changes that occurred from 2017, not necessarily something that came into play this year. So number 1 was a child tax credit. So they increased the child tax credit from $1,000 now to $2,000. Truthfully, if anything, this is something that is different, mostly because of part of the stimulus that was awarded or declared from 2020 and 2021. There were a lot of advancements of the child tax credit to provide more stimulus into the economy. But collectively, the child tax credit is still $2,000 per dependent child. Now, if you have a dependent other than a child, right, in this context, we're saying 17 and under, but anyone that is a dependent that's not under 17, you do get a $500 credit. So please understand what a credit is in this context, right? We explained what a deduction was. That's something that reduces the total income before your income tax is applied. We talked about an exemption, what an exemption was and no longer is offered. A credit is something that immediately applies to the tax liability itself, right? So when you're getting a credit, that's going to reduce the actual tax amount or tax liability that you have, which is important to understand when we talk about fully refundable. So even if no taxes are owed, you're fully refundable of that credit up to $1,500. So if you're getting a return, if you're getting a refund, or say you just break even, if you're someone who's eligible to receive this child tax credit, there is a refundable amount of $1,500. So please understand what a credit is, what the change is there, that $2,000 per dependent under the age of 17, and you have $500 credit. Will also change here that there was a phase out. Previously, there was a phase out to the amount of income a single or a married couple could earn in order to receive this credit. They made it more accessible. As you can see now, the credit phase out won't apply until $200,000 for those single filers and $400,000 for those couples or married filing jointly. So, a question to ask yourself: are we now eligible for expanded child tax credit, and how will we use the additional funds? So, if you have a growing family like my partner, Mr. Emmett Corboy, this is a question you may want to ask yourself as you enter into the new year. Number two, 529 plans, right? Something that many of you may have or may be considering. Previously, there wasn't a lot of flexibility with 529 accounts. Originally it was naturally designed for secondary level of education, college level, so on and so forth. So in the new tax law that passed in 2017, they do allow you to use up to $10,000 per year for private school, or I wrote it down, parochial school. Hopefully I pronounced that right. $10,000 per year for those levels of education. So now it's not just for college. You can use it for K through 12. And if you're someone that needs an ABLE account, that typically goes into special needs planning. Up to $15,000 from a 529 can be rolled over into a 529 ABLE account. One additional thing I do want to mention for 529s that wasn't immediately in that tax law was there is a lifetime allowance for $10,000 to be used for student loans as well. So again, enhance the flexibility from 529 accounts to be utilized for education. $10,000 for K through 12 private school per year, $10,000 lifetime for student loans, and up to $15,000 can be moved from a 529 plan to a 529 ABLE account. So some detail, what you want to review: the Tax Act created more flexible use of the 529 accounts. Again, they can help fund K through 12 of education up to $10,000 per year. And keep in mind the state that you're in or the state plan that you're participating in as well. So for example, in the state of Virginia, they allow or they offer a tax benefit for contributions made to a 529. You are eligible to deduct a certain amount on your state taxes for the amount that you put into a 529. So you do want to be familiar with the state that you reside in and what they offer for their state appropriate 529 plan. So a key question to ask yourself: are you paying private school tuition that could be funded with a 529 plan? Or what is the strategy that you're utilizing your 529 plan for? So that was number one. Number two, number three within this key is starting in 2019. For anyone that experiences a divorce after 2018, and if you're paying or receiving alimony, the tax treatment of that is going to be different. So this is for new divorces, not all divorces. But if your divorce is finalized after 2018, if you're paying alimony, that is no longer a deductible expense for the payer. And for the recipient receiving that alimony, that is no longer seen as taxable or is considered income for tax purposes. So they're changing how alimony is paid and received from a tax standpoint. If you're someone that is experiencing a separation or divorce, what that does, it changes the planning from an attorney standpoint, right? So you want to consider the tax implications of a divorce following 2018. Attorneys may need to do more with less. So what you want to do is consider consulting with a tax professional if you're someone that is experiencing or may be likely to pay or receive alimony. Review your financial plan to confirm enough assets and income are available. And again, seek advice of a tax professional because we are not tax advisors. Love it. So a question to ask yourself: does my divorce attorney or mediator understand the new tax treatment for alimony and how that affects my situation? I believe this may be the final bullet point here, maybe not, but Roth conversions. So this is something that's a very effective strategy as we previously talked about being in lower tax rates, the lowest that we've seen in history. Roth conversions, essentially what you're doing is moving money from a taxable account, paying the taxes in that year, and allowing that money to grow tax deferred and be accessible tax free from a Roth IRA. So previously, what you were able to do is convert money into a Roth. And if you decided to change your mind, you can convert back or recharacterize. But the new law no longer allows a do-over. So this is one of those situations where if you make a mistake, you can, learn from it and redo it. And unfortunately, they took away from the do-over. So they no longer allow a recharacterization of a Roth IRA conversion. So there are no more do-overs. Mm-hmm.
So yeah, I just wanted to add one thing on, Roth IRAs, which I think this slide kind of talks to a bit, which, you could look at a year like this year where the market's down, and if you have dollars in a pre-tax vehicle, now could be a potential time to convert as well. So I think you're probably going to touch on that here, Marcus. So, sorry about that.
Honestly, I'm glad that you mentioned it because, again, perfect caveat, perfect segue.
Right.
How you should look at this, since we can't do over, what you do want to consider are smaller conversions over several tax years. Maybe it doesn't make sense to convert the entire bucket all in 1 year. Maybe it makes sense to stretch them out until the sunset provision in 2025. So what you do want to consider is, future cash flow, and your ability to pay the tax bill for the amount that you convert in that year. Consider potential for market slides, as Emmett said before. In addition to low tax rates, we're dealing with a volatile market where, you may be able to convert a lower amount and experience the gain or the recovery in a tax-free bucket. I mean, I can't think of anything more exciting than that. So consider timing the conversion for later in the year for the appropriate time in the market and your situation. And again, seek a tax advice from the proper professional. We can handle the investment perspective, but from a tax perspective, we're not tax advisors. So some other insight to consider, consider a balance, right? As much as we advocate for Roth IRAs, it's because of the belief that tax rates will be higher in the future. There is a chance that tax rates may be lower, or your situation may lead for a traditional IRA to be more effective for your income. So the traditional IRA, it's more disposable retirement income if future tax rates are lower, right? The Roth IRA, you can pay the taxes now and you benefit if tax rates are the same or are higher in the future. So if you want a balancing act, there's a rule of thumb here that they encourage. You can contribute to a traditional IRA, or take this in the context of your 401k. You can take your age plus 20%, put that into a pre-tax account, whether it's an IRA or a 401k, and the difference you can contribute to a Roth account, whether it's a Roth 401k or Roth IRA. Emmett?
Yeah, so just kind of some of the reasoning there is the Roth vehicle, with that growing tax deferred and then being able to access that tax-free in retirement, that's really, really most powerful the longer that there is for that money to grow. So when you think about, the rule of 72, which is a mathematical equation kind of showing how money grows and how, money should double over time. If we use a 9%, I'm going to throw a lot of numbers out here, so just stick with me. 9% interest rate, that money would double about every 8 years, right? So 72 divided by 9 is 8. So, when we think about $10,000 in our 20s, that's 20,000 in our 30s, 40,000 in our 40s, 80,000 in our 50s, and 160,000 in your 60s, right? If that money's pre-tax in your 20s, well, then that's $150,000 that you would have to pay taxes on in your 60s, right? Whereas if that $10,000 you pay taxes on in your 20s and it grows in a Roth vehicle, then that all could be tax-free, at that point of retirement as well.
So as much as I absolutely love that example, I forgot to disclaim at the beginning. Anytime you join our experiences, have your favorite beverage. I'm a big water guy because as you can tell, we're dealing with complex information, and then we just added a mathematical equation in there. So, but that's a perfect example of understanding the context and the time and the benefit of Roth with time. If you don't have as large of a time window, a Roth IRA may not be the most effective vehicle for you with a short amount of time to allow to grow. So please, as Emma said, keep that in mind and keep that in consideration.
Mm-hmm.
So a question to ask yourself, am I saving money in the correct retirement account? It's not always about asset allocation. We also want to make sure we have proper asset location. So we want to diversify your tax liability as well. So number 5, there is a longer period for you to pay or repay outstanding loans against your retirement plan. This will come into play if someone has a loan outstanding on their current employer plan or their former employer plan, and they decide to roll those monies into a new employer plan or into an individual retirement account. Previous law was the moment that you roll that money over and there's an outstanding loan, the loan will be considered to consider default. And what that would cause is a tax liability on the defaulted loan. And if you're underneath the age of 55 or 59 and a half, you may also trigger a tax penalty, 10% tax penalty. Under the new law, now they do offer an extension. So now they offer a 60-day or a longer repayment opportunity to repay the loan to avoid any default or tax penalty. So a question to ask is, if you leave your job, do you have any loans from the former employer plan that can be repaid or rolled over? And finally, under the family change, the estate tax. So this is something a little bit different. It did not immediately impact many families or many individuals. And now with the change, it's decreased the amount even more. So the individual top rate of 40% on estates over 12.06 million for individuals. It previously was 5.6. So they doubled the amount to avoid estate taxes. And for married couples, previously it was 11.2 million, but now it's 24.12. So there's a generational skipping transfer tax exemption increased to 10 million. So if you're someone that's dealing with a large estate, you just want to keep in mind or consider, with this change, does this change my estate tax plan, or does this change my estate plan? Because only 8 per 1,000 estates will be expected to owe tax now due to this law. What you want to do is check your wills and trusts with your estate planning attorney to ensure formulas are still applicable. And you keep in mind your state tax laws as well, right? This is more of a federal law change. You may want to remember that states have their own laws pertaining to estates as well. So with that change, it is effective to look into how your estate plan is currently arranged and set up, and what will be the most tax efficient way of passing those assets down. So planning remains critical for large, closely held businesses as well. Estate planning remains complex and important for all families, so you do want to look into that. And again, seek the proper tax advice from the proper tax professional and the financial advice from the proper financial professional. Emmett?
And yeah, another thing that I'll just kind of, add to that, that's for the estate tax, right? Keep in mind, individual accounts that you may have, like those traditional IRAs that we were talking about, that money, when it passes to your beneficiary, whoever that may be, they would still have to pay taxes on that, even if you're under that estate tax threshold. So your accounts and your assets can be taxable without having that additional estate tax as well. So that's another, important reason to consider, pre-tax versus Roth. And, life insurance is a vehicle that, is tax-free from an income tax standpoint as well.
So a question to ask yourself, have you reviewed your will and trust to understand if the new estate tax exemption may cause unintended outcomes to your estate plan? And the second question is, does my estate plan include life insurance, bingo, to cover estate taxes that now won't be levied.
All right, so wrapping up here with key number 4, this is, completely regarding businesses. All businesses really are facing new opportunities regarding how they pay taxes and what deductions and depreciation they can claim. So this here is key number 4. 3 tax rule changes of interest, and we're just going to kind of speed through these here. The first one, businesses will pay a much lower tax rate. The corporate tax rate now is 21%. Previously, it was 39.6%. And the corporate AMT, or alternative minimum tax, is eliminated. So, no corporations have to worry about that AMT anymore. This change is one of the very few within this Tax Cuts and Jobs Act that was permanent at that point. Permanent has its own definition to everybody. I think, we've seen tax laws change, as time goes on. So I don't know if that means that it's going to be in force for the next 10,000 years or just until the next tax law change. But this one is permanent. The second thing, small business owners, which, most of the businesses out there are small businesses. Small business owners get a 20% deduction for what's known as pass-through income. Previously, it was up to the rate of 39.6%, but now provides a 20% deduction for pass-through income. And there are phase-out ranges in there as well. But this is one of the deductions that stops after 2025. So this one is set to sunset after 2025. So with this, 92% of private businesses in the U.S. are organized as pass-throughs. So this is something that's probably impacting you if you're a business owner, or other folks who you may know who are business owners. This would include any sole proprietorships or partnerships, LLCs, S corporations, that sort of thing. All of those are considered that pass-through. This does become unavailable. It's no longer an option when total income is over $213,000 for individuals, or somebody who's married filing jointly. That would be $426,000. And a couple with a small business that has less than $315,000 of total income could pay $20,000 less in taxes. So this certainly, can be a big help to some of those small business owners that provide something around 75% of the jobs in the U.S. as well. Key thing, seek counsel from your tax advisor. So question to ask yourself, if you're a business owner, can you take advantage of that 20% small business income deduction? Or if you're not registered as one of those pass-through corporations, should you consider changing your business structure for better tax treatment? Maybe when you originally started your business, you set up as what's known as a C corporation, which is not a pass-through, right? Maybe at this point, it might make sense to evaluate where you're at and see if a S corp or LLC may, make better sense for you at that point. All right, number 3 here, small businesses can more quickly depreciate certain expenses. So 2 measures for increased deductions that could impact business owners and present potential tax savings. One is bonus depreciation, and the next is Section 179 rules that give businesses more options for expensing property and equipment. The cap on expensing these business assets increased to $1 million. which previously was $500,000. So that, can allow somebody to have, kind of potentially, more equipment, property that they may purchase that they can depreciate over the years. And, that can actually be done, more quickly, which can help more year over year as well. So what to think about here? Ding, 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 ding. Question to ask yourself: what business equipment purchases or business improvements are we contemplating that, now could receive a more generous depreciation? Right. So maybe you're on the fence about, that new excavator or, new printing press, but now it makes sense to jump in because it's going to be a lot more favorable from a tax standpoint as well. Okay, everybody take a deep breath. We've reached the recap. Thank God.
This has been a very lengthy experience, hasn't it? Thank you for
fun.
sticking with us to this point. Yeah, it's been great.
Yeah.
And just background things, but Emmett was, he and I, we had some conversations about why we wanted to address this, especially considering a lot of the information is from 2017 in the new tax law, and we're currently in 2022. And what we both agreed is that it's important to keep in mind that a lot of the things that we've now gotten accustomed to this point are sunset to change or expire after 2025, right? And there are a lot of things that we've experienced where, from an investment standpoint, economic standpoint, we're keeping eyes out for, recession, and we've dealt with COVID and robust stimulus. So you have to think all of the different ways that we've raised or increased money. There's going to be a way that we have to pay for it on the back end. And typically that can lead to increase in tax rates or some type of change, especially when we're talking about Social Security, which are one of the webinars that we do regularly throughout the course of the year. We're talking about the solvency with that. One of the solutions may also lead to an adjustment on tax rates in some shape or form. So what we want to do is make sure that you're empowered and prepared for what the new year will bring, which we know tax season always starts January 1 and ends April 15th, right? So just some things to keep in mind are many deductions have been eliminated or changed, right? But be familiar with now what the standard deduction is for the 2022 tax year. High tax states feel the tax pinch, right? The cap on the SALT or state and local taxes and what amount of your mortgage interest you can deduct. Many family-related tax issues to address, right? The change of 529, the increase of the child tax credit, the adjustment with alimony, and business owners may benefit from a range of changes, right? More of the corporate benefits are more permanent with the change in the tax rate, permanent until the next tax law. But the 20% pass-through deduction is sunset to expire after 2025 as well. So some unanswered questions are, again, how do these changes affect me, right? Will these laws cost me money or will I benefit? How can I position myself to benefit even more? What do I need to change? What do I need to adjust now and in the future? And what do I need to worry about? So following this presentation, if you joined us, we do have a synopsis. We have this little PDF that gives you a summary of the keys, gives you ideas of the tax bracket that you'll receive in your email. And we thank you for joining us this evening. Again, we encourage you to consult with us for financial matters of, understanding the plan and the impact on the plan, but allow us to connect with your tax professional, the person that you trust to file taxes, that you get your tax advice. Allow us to work in tandem with them to provide you the best advice and the best experience. So to this point, if we do not have questions, we do bid you a good evening. We thank you for joining us for this experience, and we can't wait to see you on the next one. So tell a friend, invite a guest, and we will see you at the next experience.
Good to see everybody. Thank you.